Drive down any busy road in Florida and you'll pass a dozen of them without a second thought. A row of shops, a nail salon, a pizza place, a dentist, a phone store with parking out front. The humble strip center, investors chase flashier assets and walk right past it. But the strip center might be the most resilient cash flow machine in all of commercial real estate. Here's how the economics actually work and why it's one of the smartest plays for the everyday investor. First, what exactly are we talking about? A strip center is a row of retail units sharing a parking lot and a roof line. The smallest are unanchored convenience strips, under 30,000 square feet, filled with local service tenants. Step up and you have neighborhood centers anchored by a grocery store and community centers anchored by big box retail. As a rule, the bigger the anchor, the bigger the draw. Each format trades risk for stability. An unanchored strip is cheaper to buy and simpler to manage, but you live and die by small local tenants. A grocery anchored neighborhood center costs more, but that anchor pulls steady, recession resistant traffic past every inline shop week after week. Most private investors target that middle ground, the neighborhood center. So where does the money actually come from? Two words: inline rent. The anchor signs a long lease at a low rate, maybe $8 to $15 a square foot, precisely because it brings the crowd. The real profit sits in the small shops surrounding it, who will pay 2, 3, even 4 times that rate just to be next to all of that foot traffic. In a triple net structure, NNN, tenants don't just pay rent, they reimburse their share of property taxes, insurance, and common area maintenance. That largely shields the landlord's income from rising expenses. Your net operating income is the base rent across every unit minus vacancy and the cost you can't pass through. Keep that center 90 to 95% leased, and the cash flow is remarkably steady. Never underestimate the anchor effect. A busy supermarket can generate tens of thousands of visits every single month, and every one of those shoppers walks right past your inline tenants. That's why a nail salon or a sandwich shop will gladly pay a premium to sit beside a grocery anchor. The anchor isn't where you make your money. The anchor is what makes the money possible. Now, the lease structure is where strip centers get interesting for investors who want mostly passive income. Multi-tenant retail is typically leased triple net. Each tenant signs for a base term, often 5 to 10 years, with rent escalations baked in, and reimburses their pro rata share of the operating expenses on the property. Anchors sign the longest leases, 15 to 25 years, usually with renewal options, which gives the whole center stability and makes it financeable. The small shops roll on shorter terms, and that's actually an advantage. It lets you mark rents to market every few years as the area grows. Escalations of 2 to 3% a year mean your income climbs even while your tenants stay put. Because strip centers take more hands-on management than a single-tenant building, buyers demand higher returns. Grocery-anchored centers with strong tenants trade around 6 to 7%. Unanchored multi-tenant strips push 7 to 8.5. And the pad sites out front, a bank, a coffee drive-through, those single-tenant outparcels trade at the lowest, safest cap rates of all. Prices range from a couple million for a small strip into the tens of millions for a major center. Here's the risk every strip center buyer must understand: co-tenancy. Many inline leases contain clauses tied directly to the anchor. If that anchor goes dark, closes its doors, those small tenants can be entitled to reduced rent, or even the right to terminate their lease. One empty anchor box can trigger a cascade. That's exactly why anchor credit, lease term, and tenant mix matter far more than the sticker cap rate. But risk cuts both ways, and strip centers offer some of the best value add upside in commercial real estate. Buy a center with vacancy or below market rents, and you have a clear playbook. Lease up the empty units, renew tenants at market, sharpen the tenant mix, and add an outparcel pad in that oversized parking lot. Every one of those moves lifts net operating income, and at a 7% cap rate, each extra dollar of NOI adds roughly $14 of value. And the location fundamentals are firmly on Florida's side. The state is adding roughly 1,000 new residents every day. No state income tax. A steady wave of businesses and families moving in. All of that demand has to shop somewhere. And necessity retail, the haircuts, the takeout, the urgent care, the dry cleaner simply cannot be shipped in a cardboard box. That's what makes a well-located Florida strip center so durable. Put it together, and the strip center is a flexible, durable asset. Steady, triple net income from a diversified tenant base, real value add upside, and pricing that ranges from a few million into the tens of millions. It rewards active owners who manage the tenant mix. And it's a favorite landing spot for 1031 exchange buyers trading out of management heavy properties into something with built-in growth. The strip center is proof that the most overlooked assets are often the most resilient. The economics reward investors who understand tenant mix, lease structure, and location. If you're evaluating multi-tenant retail or neighborhood centers in Central Florida, that is exactly what we do at MaxLife Commercial. If you'd like an experienced set of eyes on a deal, the link to connect is in the description.